Hey, everybody. Thanks for joining today. We're going to talk about when earnings go up but stock prices fall. It's not that uncommon, but it's kind of a basic um, valuation compression that we see periodically, and we're ripe to see now, especially in the semiconductor chip making industry. And so let's talk about what's going on there. So, the valuation formula, so a stock price is equal to earnings today times a multiple of expectations for what people think the company's going to do in the future, how much money they think they're going to make in the future. So higher multiples mean higher expectations. Pretty simple. Higher expectations means smaller margin for disappointment. So when earnings come out and it's not as stellar, or it's not as quickly, it's not growing as quickly as it was in the prior quarter or the prior year, that's when we missed expectations. And even though earnings can be growing, the stock price can fall. So let's look at an extreme example of that. And that was during the dot-com bubble between 2000 and 2002. You could see Cisco, Microsoft, Intel, and Qualcomm all dropped between 86 and 82%, or 62%. Um, Dramatic drops, even though earnings were up over that period of time. That was because investors drove the price of those stocks up really high, to very high multiples, in some cases over 100, which is just extreme, because they thought that the dot-com and the internet boom and craze was just going to keep on going, and they were going to see earnings skyrocket for many years. And they did go up. So let's dive in a little bit to Cisco. So between 1999 and 2002, earnings were up 72%, but the stock price was down 89%. That just meant that there was unrealistic expectations in 1999. It's a great company. All those companies on the prior slide are great companies, but you could still see valuation compression and stocks go down. So diving in a little bit more of what happened to Cisco in 99, investors expected explosive growth. It was trading at 127 PE at peak. That's just ridiculously high. And so when the compression occurred, the stock price dropped, and in 2002, it went down to 16x. So the multiple was 16x. It got much more realistic, as I actually would have been a great buy at that point. So the market didn't get the company wrong, it got the expectations wrong. So looking at valuations today or earlier this month, you can see that we're not in that craziness that we were in the dot-com stage. Most of the valuations are in the 20s for these tech stocks, with the exception of Tesla. That's crazy, 182. Palantir, that's a little crazy, 84. Everything else is within reason, but it's still high. Like if you look at the 5-year and the 10-year historical average, we're still above that. So it is high, but it's not crazy high. We can still see some valuation compression if we don't continue to see great earnings growth in the tech sector. So, for example, right now with the valuations in the 20s and 30s, we are baking in, or the market is baking in, some expectations to that price. They expect, for example, Amazon, somewhere around 29 to 30, in that range is their forward PE. So that what's baked into that price is that the AWS growth will remain strong, enterprise customers will increase their AI workload, and that retail and ad business stays strong. And if one of those three things doesn't happen, earnings might go up a bit, but if it's not going up as fast as this market has priced in, then the stock price will drop. So the reason most of the time you see forward PEs in a range is because different data providers use different consensus earnings estimates. So forward PE isn't standardized. Sometimes some use the next 12 months, while others use the next fiscal year. And then as stock prices change, of course, the forward PE changes. So that's why you usually see it in a range. But I just gave a point in time number here. But most of these companies are in the low 20s to high 20s range, which is high compared to our historical averages, but not bubble territory or not crazy territory like we saw in the dot-com boom. The exception to that is Tesla. That's crazy territory, and Palantir. That's crazy territory. So anyway, the takeaway is great earnings don't guarantee a higher stock price. Market rewards realistic expectations. So how does this all fit into our market vulnerability index? That's something that I update every month, and it measures 8 different weighting factors and tells us how vulnerable the market is compared to history. And so a 25% of this score is valuation, which is CAPE and Buffett indicators, which are historically high. But the interesting thing is, if CAPE and Buffett indicator are so high, near record levels, how come the multiples aren't near record levels? So what's going on there? And I think the answer is that the expectations are for great earnings growth. The analysts are expecting great earnings growth. They're expecting continued investment in AI, expecting continued investments in semiconductors. And so there's a lot of baked in expectations to the current stock prices. And if for some reason those expectations are missed, I do believe we will see some corrections or flat stock prices until the earnings catch up. So with that, let's keep looking at this vulnerability score. I think what would drive it up next would be some contraction of the liquidity should interest rates go up, and looking closely at inflation and employment numbers. All of that's going to be really interesting in the next few months. Thanks a lot. Thanks for watching. If you have ideas of future topics, let me know, but we'll continue to dive into this. Thank you.